All right, how you doing out there? Bill Campbell back again. We're going to talk about security market indices, another exciting topic. Here we go. A security market index. This represents the value or performance of an asset class, security market, or market segment over time. It's like a hypothetical portfolio. You pretend that you invest in certain stocks. Could be like we say, an asset class, so it could be large cap stocks, or it could be a particular market. It could be healthcare stocks, or financial stocks, or a regional market, or chop it up almost any way you want. The index value is calculated from market prices on the securities. So we take a look at the securities that we have in our index. As those security prices change, as I say, we treat this like a hypothetical portfolio, so the value of our portfolio changes. Notice this last bullet point. There are various weighting schemes that we can use for putting these securities in our portfolio. And if we use a different weighting scheme, then the total return on our portfolio is going to change. We'll talk about the different weighting schemes in a little bit so you can see what those differences are. Two ways that we can calculate the return for our portfolio. We can calculate just the price return, so the ending price divided by the beginning price minus 1. That would ignore any cash flows, that would ignore any dividends, that would ignore any coupon payments, and so on. Or we can calculate the total return, which would include those cash flows, include the dividends, include the interest. The total return would be the ending value of the securities plus the value of any cash flows divided by the beginning value of the securities. All that minus 1 would be the total return. So when you establish this index, in addition to determining what securities are going to be in there, in addition to determining how you're going to weight the securities, you also have to determine how you're going to calculate return. Are you going to calculate only price return, or are you going to calculate total return? What are some of the issues that come up in construction of the index? Well, the first thing you have to decide is what market is this index going to represent? Is this going to be a broad equity market? Is it only going to be large cap stocks or mid cap stocks? Is it going to be only growth stocks or value stocks? Is it going to be only domestic, or will we have some international securities in there? Will it be only stocks, or will it be maybe stocks and bonds? If it's bonds, will it be government bonds or corporate bonds? You have to decide what market's going to be in, what you're going to represent. Once you've decided on the market, then you have to decide the specific securities. For example, the S&P 500 is supposed to be the 500 largest publicly traded stocks in the U.S. How do you decide exactly how to measure that? How do you decide when you're going to add one security and drop another security, and so on? What weighting method are you going to use? We'll talk about price weighting, we'll talk about value or market cap weighting, we'll talk about equal weighting. Each of these different methods will produce different return values for the portfolio. How often will the index be rebalanced? If we have equal weighting, for example, then we need to rebalance maybe quarterly, maybe semi-annually. If we have particular target weightings, like we have an index that's supposed to be 70% large cap and 30% mid cap. If the large cap starts outperforming it, it gets overweighted. How often do we rebalance, and so on? And when will the index's securities be re-examined? How often are we going to look to determine whether, for example, we should drop one security and add another? If we have, let's say, the S&P 500, how often do we look to see whether or not one of the securities that we have, that company is no longer in the top 500 and has been replaced by a different company? When do we make those changes? How often? And so on. So these are the decisions you have to ask yourself when you are creating and maintaining an index portfolio. Okay, The first of the weighting schemes is what we call price weighted. Price weighted, we take the sum of the stock prices in the numerator and we divide by the number of stocks in the index. Now notice in the denominator it says the number of stocks in the index adjusted for splits. After splits, I want you to write in a couple of other words. It's adjusted for splits. It's adjusted for stock dividends. I'll just abbreviate that, dividends. And it's also adjusted for new stocks. So every time you have a stock split, every time one of the stocks pays a stock dividend, or every time you drop an old stock and replace it with a new stock, you have to adjust that divisor so that you get continuity in the index. A price-weighted index, the type of portfolio it's modeling would be a portfolio where you buy the same number of shares of every stock in the index. So it would be as if you had bought 100 shares of stock A, 100 shares of stock B, 100 shares of stock C, and so on. Notice the next bullet point down there. Because a 1% price change in a high price stock will be a much bigger dollar value than a 1% price change in a low price stock, the performance of a price-weighted index tends to be biased toward the performance of the high-price stock. So if you included Apple stock in there, which is trading somewhere around $600 a share, that's going to have a much bigger influence than than would another stock that's only trading at $50 a share. $600 a share, a 1% increase is much bigger than a 1% increase of a $50 per share stock. A couple of examples, the Dow Jones Industrial Average and the Nikkei Dow Jones Stock Average. These are both price-weighted indices. Market cap weighted. We start off, the market cap weighted, we start off with a beginning index value. Commonly, these beginning index values are going to be nice round numbers, 100 or 1,000, something like that. So we start with the beginning index value. And on the day that we create that beginning index value, we compute the denominator down here. We take for each security, we take the price per share times the number of shares outstanding on the day that we started this index. That's going to be our denominator. It won't change. Our numerator up there on the top, notice that is going to change. That's going to be today's price times the number of shares outstanding today for each one of those stocks. So it's the total market cap for stock A and the total market cap for stock B and the total market cap for stock C. Add those all up, divide that by the total market cap for all of our stocks the day that we started the index, multiply that ratio by the beginning index value, that's the current index value. So now instead of purchasing the same number of shares of each stock, a market cap weighted index represents a portfolio that owns all outstanding shares of each stock. So it owns all the outstanding shares of stock A and all the outstanding shares of stock B and C and D and so on. The firms with the largest market capitalization are the ones that are going to have the greatest influence on the index. A company that has a $10 billion market cap, if the price goes up 1%, will have a much greater change than a company that has a $100,000 market cap. So it doesn't matter exactly what the share price is, but what the total market capitalization is. And this index is biased toward the firms with the largest market capitalization. Examples of market cap weighted indices are the S&P 500, the New York Stock Exchange Index, and the Wilshire 5000. These are all market cap weighted indices. Market cap indices tend to have a momentum tilt in the sense that stocks that are overpriced tend to be overrepresented in the index. Because if the price were lower, then the total market capitalization would be lower, and therefore the percentage that these stocks would constitute in the portfolio would be smaller. Now, another issue with market cap weighted is what we call free float adjustment. When you calculate the total market capitalization, you can either calculate the capitalization of all outstanding shares, whether or not you honestly believe that those shares would be available to an investor, or you might only calculate the market cap for the shares that you think are really trading on the open market. So some companies, for example, might have the founders of the company may own a significant portion of the stock, and they never plan to sell it. Those shares really aren't available on the open market for sale. In that case, if you were going to adjust for free float, well, those shares, you don't consider those to be free float. They're not available, so you exclude those. Sometimes you might have a situation, I know this is fairly common in Japan, where if you have two companies that have a strategic business arrangement, Company A may, as a show of good faith, buy a large number of shares in Company B, and Company B buys a large number of shares in Company A. Once again, it's unlikely those companies are going to sell those shares. They wouldn't be available on the open market. Therefore, we wouldn't include those in our market capitalization. So you calculate the total market capitalization, and then you exclude the shares that you think are not going to be available on the open market. Only use the shares that are available. We can also use fundamental index weights. Here, the weights in our index are based on fundamental factors about the companies. For example, they might be in proportion to the company's revenues, or the company's earnings, or the company's book value, or the company's cash flow from operations. This is another weighting scheme. Now, this one, of course, you can imagine would change potentially significantly from one year to the next. So this would be one where from one period to the next, you may have to do a fair amount of rebalancing to get back to appropriate weights. Fundamental index weights tend to have a value tilt. That is, companies with high book-to-market price ratios will then have a higher relative revenue or relative earnings or relative book value, and therefore have higher weights than companies with a low book-to-market ratio. So it tends to be tilted more toward value stocks. If you have a fundamentally weighted index, but it's multinational, so you have several countries represented, then within the index, the proportion from each country is weighted by that country's GDP. So let's say, for example, that you have an index that is going to represent companies in Mexico, the United States, and Canada. And let's say the GDP of the United States is 80% of that total GDP. That may be too high. Let's say 70%. And Canada's GDP is 20%, and Mexico's is 10%. Then within that index, the stocks that you have from U.S. companies would represent 80% of the index, from Canadian companies 20%, from Mexican companies 10%. You would use GDP weights for the countries in the index. We can also have an equal weighted index. This gives the same weight to each stock in the index. So it's as if we bought the same dollar value in each stock. We bought $1 of stock A and $1 of stock B and $1 of stock C, and so on. So to calculate the return here, we simply average the holding period return for each stock. The small stocks have the same weight as the medium stocks, has the same weight as the large stocks, so we just average their holding period returns. It's common when you have equally weighted returns to rebalance quarterly. So quarterly, you may move new stocks in, old stocks out, and so on. How do these compare with each other? Well, as I said before, price-weighted indices place more weight on the high-priced stocks, less on low-priced stocks. And remember that whenever you have a stock split or a stock dividend or an old stock out and a new stock in, that's going to change the divisor, which changes the weights on everything. An equal weighted index places more weight on small cap stocks simply because small cap stocks tend to have greater volatility in their returns. So they will have high returns one period, low returns the next. Very large positive returns, one period, very large negative returns the next. And it treats all returns as being equal. So the larger the return, the more weight it has. If you have a market cap weighted that, or if you have a market cap weighted that is float adjusted, that better matches the investable shares. If you don't adjust for float, then you're including shares that really might not be available to an investor on the open market. And finally, a fundamental weighted index tends to be tilted more toward value stocks, those with the higher book-to-market ratios. Let's do some calculations. Suppose that we have three stocks, A, B, and C. Share price on November 30th, $20, $30, $40 respectively. Number of shares outstanding, 300, 200, 100 respectively. So we have the total market value. So on November 30th, the total value of our portfolio is $16,000. On December 31st, the prices have changed to $22, $27, and $44 respectively. Notice we have the same number of shares outstanding. The value of the portfolio has gone up to $16,400. If we had a price-weighted index, then we would take the average share price, $20 plus $30 plus $40 over 3. So the average share price is $30 a share on November 30th and $31 a share on December 31st. So 31 divided by 30 minus 1, which is the same as 93 divided by 90 minus 1, that's an increase of 3.33%. So if our initial index value were 100, our new index value would be 103.33. If we did it with market cap weighting, then our market cap went from 16,000 on November 30th to 16,400 on December 31st, which is an increase of 2.5%. So if our beginning index value were 100, our ending index value would be 102.5. So remember, with price weighted, it went from 100 to 103.33. With cap weighted, it went from 100 to 102.5. So you can see immediately that using a different weighting scheme, we get a different value for our index. If we were using an equal weighting on our index, then we would calculate the return, the holding period return on each stock. So the first stock lost 10%, the second stock lost gain 50%, third stock gains 10%. We take the average of those plus 16.67%. So if our initial index value is 100, the next period it would go up to 116.67. A couple of other terms you need to understand with respect to indices: rebalancing and reconstitution. Rebalancing is simply changing the index weights periodically. So, for example, if you wanted to have an index, a custom index that was, say, 70% stocks and 30% bonds, if the stocks start out performing and their price goes up, you would have to remove some of the stocks and add some bonds to rebalance it back to the initial weightings. Reconstitution means adding or deleting securities. So if you have, like, the S&P 500, maybe at some point one or two of the last one or two securities in the S&P 500, the smallest, maybe they drop out and one or two others come in to replace them because they've grown a little bit faster and now have surpassed those last two. So that would be reconstitution, where you drop one security, add another. The Dow Jones Industrial Average, for example, it represents only 30 companies, and they don't remove one company and add another very frequently. And it's always a big deal when they do, because there are so few companies in there that when they drop one and add another, it makes the news. It's a really important deal. Okay, let's take a look at some problems here. Problems on index weighting. Compared to a market cap weighted index, a fundamental weighted index based on dividends will place more weight on firms with higher A, dividend yields, B, dividend per share, or C, total dividend payments. Compared to market cap, and the correct answer is that it will place more weight on companies that have higher dividend yields, because higher dividend yields as a percentage of firm value will have higher dividend proportions than market cap proportions. Remember, the dividend yield is dividends divided by share price. So if it has a higher dividend yield, then its dividends are higher as a proportion of market cap. Therefore, it would be higher weight in that index. What are some of the ways that we use indices? Well, one way is to gauge market sentiment. As the values of the stocks in the index go up or down, that gives you an idea of how the investing public thinks about that particular array of stocks. So if you have like a segment index, it lets you know whether the investing public is in favor of that segment, prices are going up, or if the prices are going down, maybe that segment is out of favor. Frequently, indices are used as performance benchmarks. If you recall from the study session on portfolio management, that part of the initial work in managing a portfolio is to establish a benchmark against which your performance is going to be measured. It's also a measure of the market return. You can use it if you have, say, a broad market index, then the return on the index would give you a good indication of the return on the market. How might we use that? Well, take a look at the next point, calculating beta. We would take the returns on a particular security, compare them with the returns on the market, and use that to calculate beta. If you don't recall, the way that you calculate beta is you plot the market returns on the horizontal axis versus the security returns on the vertical axis, draw a least squares best fit line, so a regression line through those, and the slope of that regression line is beta. So the market returns and the securities returns are used in the beta calculation. It can also be used to calculate expected and risk-adjusted returns. Remember that the CAP-M to calculate the expected return using CAPM, you have the risk-free rate plus the beta, well, we already used the market returns to calculate beta, times the market risk premium. That's the excess return of the market over the risk-free rate. So we need the market returns so that we can calculate the market risk premium, so that we can calculate expected returns using CAPM. Finally, it's also used as a model portfolio for index funds. An index fund, a mutual fund, or an ETF that tracks this index, the index then is used as the model portfolio. What are some types of equity indices? Well, a broad market index could have large cap, mid cap, small cap, stocks in all sorts of sectors. They could use any of the weighting schemes we talked about: value weighted, price weighted, equal weighted, fundamental weighted. You might have a multi-market, so you might have an equity index that has securities not just from a single country but from multiple countries. And it could be market cap weighted, so the weightings of each country within that index would be determined by the total market cap of those securities in that country. Or you could have multi-market with fundamental, like GDP weighting, where within that index the weighting for each country is determined by that country's GDP compared to the GDP of each of the other countries. You could have just a sector index, where you have an index that only follows, only includes stocks from healthcare companies, or only technology companies, or only financial or consumer goods, and so on. Or you may have a style index. It may be only large cap stocks, or mid cap, or small cap value, or large cap growth, or some combination of those. You can also have indices for fixed income. They can be the different kinds of different kinds of indices can have different maturities. They can have different issuers. They can have issuers from different countries, different regions, different sectors, different kinds of collateral. So you might have short-term bond funds, medium-term bond funds, long-term bond funds, government bond funds, corporate bond funds, domestic bond funds, international bond funds from only a particular region within a country, sector bond funds like healthcare sector or technology sector. You might have only bonds with a specific type of collateral, and so on. What are some of the issues in constructing fixed income indices? Well, the first is that there are a lot more bonds in existence than there are stocks. So you have a much broader universe. The other thing to consider is that bonds, unlike stock, bonds mature. So once the bond matures and it gets paid off, you have to drop it from your index and potentially replace it with a new bond. So they, just by the nature of bonds, will tend to have higher turnover than equity indices will have. If you don't have a lot of trading data on bonds, then you might not have price data to use to determine the value of your portfolio. Bonds, although there are a lot more bonds in the universe than there are stocks, bonds don't tend to trade as frequently as stocks. Therefore, there can be a lack of pricing data. And finally, certain bonds are illiquid. A lot of bonds, there's no ready market for them, so you really can't get any pricing data. And if you were to try to create, let's say, an index mutual fund or an index ETF, it might be impossible to create that because you might not be able to purchase some of the bonds that are included in the index. Therefore, when you're constructing an index, you might want to think about whether you want to include bond issues that are not particularly liquid, because you know that it will be very difficult for an index fund to replicate that. Now we have indices for alternative assets. We already talked about equity indices. We already talked about bond indices. Now we have indices for commodities. Generally, These are indices for futures contracts on commodities, not indices for holding the commodity itself. And because the futures price doesn't necessarily exactly track the spot price for the commodities, the performance of a commodities index, of a commodities futures index, may differ from the performance of the underlying commodities themselves. And for different kinds of commodity indices, there are a variety of weighting schemes. How do you decide how much wheat, how much gold, how much oil, how much soybeans to put in there? You can have real estate indices, which are used, the prices that they get for real estate industries generally come from appraisals. Some come from repeat sales, from actual market data. Some real estate indices track REITs, real estate investment trusts, and they get their data from those. So that's another type of index. They also have indices on hedge funds. One of the concerns about an index on hedge funds is that the hedge funds are the ones who report their pricing information. So they can decide whether they want to report or not, and if they report, then it's usually done by some sort of subjective appraisal by the hedge fund itself, so the pricing data may not be as accurate as possible. Hedge fund indices also suffer from what we call survivorship bias, and that is that the really poor hedge funds that do terribly, well, they go out of business, and so they're dropped. So the hedge funds that remain in the indices are only the good ones, only the best of the best. So you may see an upward bias. You may see higher returns for the hedge funds in an index than you would see in the broad class of hedge funds that exist in the market at any point in time. Okay, another problem for you. The type of index weighting that is most likely to be similar to a momentum strategy. Would that be market cap weighting, fundamental weighting, or equal weighting? I'll let you ponder that for a minute. You can pause this if you want. Okay, you've pondered it for a bit. Market cap weighting. Why? Because as the price of the stock increases, if you have momentum, so the price keeps going up, the increase in the price is going to result in an increase in the market cap, and that's going to result in an increased weight in the index. Fundamental weighting may or may not, if the fundamentals improve, that may or may not result in an increase in the stock price, so it may or may not show a momentum in the stock price. And if you have equal weighting, well, that ignores the stock price altogether. It gives equal weighting to all the returns, whether you have a high stock price or a low stock price. All right, the last few slides here are simply a table showing types of security market indices. There's not really a whole lot I can tell you about this. I would suggest that you use this. You go over it. It's in your textbook, or you can come look at the slides here. Look at the different kinds of indices. What does it reflect? What market is it representing? How many securities are there? What method do they use for weighting those? Any additional notes? So we have 3 of them here, three more on the next slide, 3 more on the next slide, 2 more here at the end. Just a sort of a cross section of the different kinds of indices. You don't need to memorize all the details. Just know what these different indices are, examples of the markets they represent, the weightings, and any special notes about them. Okay, that's enough for market indices. We'll come back and talk to you later on another fascinating topic.